What sectors of the S&P 500 perform best after a bear market? Stay tuned, you're about to find out. Before we get into what sectors do well, let's talk about what hasn't worked. Number 10 is gold mining. Since the March 2009 lows of the great financial crisis, the GDX ETF is down 13%, while the S&P 500 is up over 380%. Junior miners didn't fare any better. GDXJ is down 64% over the same time period. There are bright spots in mining, however, with the more diversified XME metals and mining ETF up 101% over the same time period. So maybe the lesson is, if you want to invest in mining, a more diversified strategy away from strictly gold can perform better. Number 9 is oil and energy. The oil services ETF, the OIH, is down 46%. The oil and gas exploration ETF, the XOP, has done okay, up 28% since 2009. However, compared to the S&P 500's 388% increase, it simply hasn't kept up with the gains from a more diversified investment. Other energy ETFs have done well, with the IYE up 69% and the widely owned XLE ETF up 92%, with most of the gains coming in the past 12 months. Energy is by far the best performing sector of 2022, up over 40%. However, a bear market in stocks followed by a global recession should slow demand for oil in the coming months and years ahead. Luckily, energy investors will bag plenty of profits and rotate into areas that stand to gain the most during the next bull market. Number 8 is consumer staples. Soda, snacks, soap, and cigarettes make up the bulk of the consumer staples index. The XLP ETF tracks over 30 companies that sell products consumers consume every day. This ETF is up an impressive 235% since 2009. Equally impressive year to date, the XLP is just down 8%, meaning you get good upside performance and slightly less downside from a basket of consumer staple stocks, making this a strong asset class across a broad range of portfolios. Number 7 is the financial and banking sector. The regional banking KRE ETF is up 212% since 2009, and the broadly diversified KBE banking ETF is up 231%. The best gains, however, come through the sector's flagship ETF, the XLF, which is up an impressive 360% since the depths of the great financial crisis. Year to date, the financial sector has actually performed better than the S&P 500, down just 16%. Number 6 is real estate. Can't afford a house in today's market? You can still invest in real estate, and it's clearly been a great performing asset class since 2009. The IYR ETF, which tracks U.S. real estate, is up over 270%, and the more diversified VNQ ETF is up 290%. But surprisingly, a less diversified segment of the real estate market has performed even better since 2009, and that is home builders. The ITB US Home Builders ETF is up over 550% since 2009, when low rates, low inflation, and rising prices were all tailwinds for the builders. The obvious difference between 2009 bear market and today is the fact that home prices have not corrected in value along with the other asset classes. The tailwinds of the 2010s appear to be reversing. Higher rates, higher inflation, and input costs, and the possibility of home prices stalling might keep the home builders from outperforming during the next bull market run. Number 5 are two sectors I'll blend into one, and that's industrials and materials. The material sector's ETF, XLB, is up 271% and includes companies like Dow Chemical, Sherwin-Williams, and DuPont. More impressively, the industrial sector has virtually matched the S&P 500 gains since 2009, as the XLI ETF is up over 380%. This ETF holds stocks like Union Pacific, Raytheon, and Honeywell. The industrial and material sectors can also perform better in a bear market, with each asset class outperforming the S&P 500 year to date, making the industrial and material sector a great choice across a wide range of portfolios. Number 4 is healthcare. The IBB Biotech ETF solidly beat the S&P 500, increasing in value over 422%, and is my preferred way to get exposure to the biotech sector. Even more impressive has been the performance of the more diversified XLV Healthcare ETF, which is up 436% since the great financial crisis. Surprisingly, recent spikes in inflation have largely avoided the healthcare sector, meaning the asset class might avoid a deflationary cycle when the economy eventually slows down. Number 3 is retail. This sector is led by the broadly diversified XRT ETF, which is up an S&P beating 435% since 2009. And if beating the S&P by a huge margin isn't enough, history shows that a more focused consumer discretionary XLY ETF can provide even more returns. This ETF is up over 600% since 2009. Not surprisingly, these sectors have declined significantly this year, and there might be a delay in this asset recovering from a recession. But history proves consumers love to shop during a bull market, and that's likely not going to change. The number 2 sector shouldn't come as a surprise, other than it's not the number 1 asset class after a bear market, and that is technology. The widely held XLK Technology ETF has alternatives like Vanguard's VGT. Both outperform the S&P 500 by a huge margin, with VGT being up an insane 850% since 2009. Both of these ETFs currently have over 40% of their assets in Apple and Microsoft, so at least in the near term, performance will be tied to those mega cap companies. And finally, the number 1 sector that has outperformed the S&P 500 by the largest margin after the last major recession has been the semiconductor stocks. The SMH ETF, comprised of a broad range of chip companies, including Taiwan Semi, NVIDIA, Texas Instruments, Broadcom, Intel, and AMD, is up over 1,000% over the past 13 years. Not surprisingly, the SMH ETF outperformance has occurred more recently in the past few years. If you track the performance of the ETF back to its inception during the dot-com era in the 2000s, the performance is actually almost identical to the S&P 500, with nearly 2 decades of underperformance. So it's not a clear-cut winner in the next bull market, but certainly a sector growth investors should heavily weight towards during the next bull market. That was how the top 10 S&P 500 sectors performed since the great financial crisis. Let me know how you're positioning your portfolio for the next great bull market.